right, let's talk about banks. We use them every single day, but have you ever stopped to think about how they really work? Today, we're popping the hood to see what's actually going on inside. I mean, you know the drill, right? You deposit your paycheck, maybe you have a mortgage, you swipe your credit card without a second thought. That's all just the user interface. But what's the actual business model running in the background? How do they turn our money into their profit? That's what we're going to break down. So let's start with a really simple idea. At its very core, a bank is basically a machine, a really complex, powerful machine that's designed to do one thing above all else: make money. And we're about to look at the blueprint. So what does this machine actually do? Well, fundamentally, it's a matchmaker. It takes money from people who have a little extra, we'll call them savers, and connects them with people who need money, we'll call them borrowers. That's it. And that simple act, that connection, is what fuels a huge part of our economy. Okay, so if they're just the middleman, how do they make so much money? Well, it really boils down to two main ways. First, and this is the big one, is something called the spread. This is the profit they make from their main matchmaking job. And second, they make money from all those fees they charge for everything else. You know, wealth management, credit cards, the whole shebang.
Let's double-click on that first one, the spread. You'll hear analysts call it the net interest margin, and it is the absolute lifeblood of a bank. Think about it like this. The bank pays you, say, 1% interest for keeping your savings with them, then they turn around and loan that same money to someone else for a 5% interest rate. That 4% gap in the middle, that's their core profit. It's the engine that powers the whole operation.
All right, so we've got the basic blueprint. Now for the fun part. Let's really get our hands dirty and look at the actual mechanics. What's the fuel that makes this machine run? And what exactly is the engine doing with all that fuel?
And this brings us to something that sounds kind of boring, a bank's balance sheet. But I promise, if we stick with our machine analogy, it's actually super simple. On one side, you have the fuel, where the bank gets its money. In accounting speak, these are liabilities, because it's money they owe to somebody else. And on the other side, you've got the engine, how the bank uses that money. These are the assets, the things they own that make them a profit.
So let's peek inside that fuel tank. The biggest, most important source of fuel is what's called core deposits. And that's just a fancy way of saying money from regular customers like you and me. But that's not all. They also get fuel by borrowing from other big financial institutions, by selling bonds, and of course, from the money put in by their own shareholders. And just to give you a sense of scale, the amount of money we're talking about is, well, it's staggering. Take Royal Bank of Canada. It holds over $1.4 trillion in deposits. That's why analysts love this number. They see a giant pile of core deposits as a really stable, really cheap source of fuel for the whole banking machine.
And this chart here just drives the point home perfectly. Take a look at that mix. For your typical big bank, a whopping 70% of its fuel comes from us, from our stable core deposits. The other sources matter, sure, but the entire machine is built on that foundation of everyday customers' money.
Okay, so the fuel tank is full. Now what? How does the engine actually put all that money to work? Well, the main way is through lending. Mortgages, car loans, loans to businesses. But they also use our money to buy things like government bonds, and some of the bigger banks have huge trading operations. Each one of these is like a different part of the engine, all designed to churn out a profit.
So we've built this massive, powerful machine, fueled by trillions of dollars. But the big question is it safe? Can it blow up? To figure that out, we need to look at what the pros look at, the analyst dashboard.
Right, so we know how it's supposed to work, but we all know things can go wrong. So to check on the health of this machine, we've got to look at the gauges on the dashboard. And you can think of this dashboard as having two main sets of dials. You've got your making money gauges over here, things that show how profitable the machine is, but then you have the not gonna explode gauges, the safety gauges. And honestly, for the rest of us, these are the ones that really matter. They tell us if the bank can handle a crisis. Now, one of the most important warning lights on this whole dashboard is something called provision for credit losses, or PCL. The best way to think about it is like the check engine light in your car. This isn't money for loans that have already gone bad. No, this is money the bank is putting aside because it thinks loans are going to go bad in the future. So when you see that PCL number start to climb, it's a huge warning sign that management sees trouble on the horizon. Okay, let's talk about the single most important safety feature on this entire machine. It's the ultimate shock absorber, and it's designed to protect the bank from all the unexpected bumps and potholes in the economy. Now, the technical term for this shock absorber is the Common Equity Tier 1 ratio. I know, it's a mouthful. But the idea behind it is actually pretty simple. It's not just about how much capital a bank has. It's about how much of the best quality capital it has compared to how risky its loans are. Think about it. A riskier loan needs a bigger shock absorber, right? That's all this ratio is measured.
So let's put some real numbers to this. Here are the ratios for a few major Canadian banks. Now, the regulators want them to be above about 11.5%. As you can see, all three are sitting comfortably above that line. So, from this gauge's perspective, their shock absorbers are in pretty good shape.
Okay, so the shock absorber is for handling big losses. But what happens if there's a sudden panic and everyone wants their money at once? For that, we need to check the machine's 30-day emergency fuel tank. This is all about short-term survival.
This gauge is called the liquidity coverage ratio, or LCR, and it asks a really simple, kind of scary question. If all hell broke loose tomorrow, does this bank have enough cash and other stuff it can sell instantly to survive for 30 days all on its own? A score of 100% is the bare minimum pass.
And to give you an example, TD Bank's LCR was 138%. What does that actually mean? It means they had a 38% cushion. They had 38% more crisis survival fuel in the tank than the bare minimum required. That's a pretty significant safety buffer. Okay, so we've been deep inside this banking machine. We've talked about its fuel, its engine, its dashboard. But let's zoom all the way out. Why does any of this technical stuff actually matter to you? Well, because the health of these machines is completely intertwined with the health of our entire economy. It really comes down to this quote: "For a bank, capital and liquidity are its lifeblood." It's that simple. If that machine breaks down because its shock absorbers are shot or its emergency fuel tank is empty, it stops doing the one thing the economy desperately needs it to do: lend money. And when the lending stops, everything else grinds to a halt. And that leaves us with the central conflict, doesn't it? The entire banking system is this constant, delicate balancing act. On one side, you have the relentless push for profits, which means more risk. And on the other, you have the need for safety and stability, which our jobs and our savings absolutely depend on. So the real question for all of us is, are we getting that balance right?